Welcome back to The Explainer. So if you caught our previous deep dives into legendary quants like Ed Thorpe and Bill Benter, you already know a massive secret. Finding a mathematical edge in the markets, well, that's really only half the battle. Benter didn't build his fortune just by picking winning horses. He mathematically optimized his exact bet sizes to make sure he survived the inevitable losing streaks. So today, we're bringing you the absolute ultimate guide to that critical other half, position sizing.
Right, because honestly, you could have the absolute best trading strategy in the world, an algorithmic edge that literally prints money in backtesting, but if you don't know exactly how much of your capital to risk on each and every trade, you are eventually going to hit zero. I'm here representing the everyday retail investor, and my main goal today is to make sure we keep all of this highly actionable.
Oh, it will be. We're going to master a concept called the Kelly Criterion. And by the end of this explainer, you're going to have a complete step-by-step Excel system built totally from scratch to dynamically size your own trades based on your personal edge.
Okay, so here's our roadmap for today. First, the Kelly advantage. Second, finding your variables. Third, Kelly in Excel. Fourth, full versus fractional Kelly. And finally, master the strategy. Let's jump right in.
Section 1. The Kelly advantage.
Okay, so I know this concept is considered the ultimate mathematical shield against financial ruin. But from what I understand, this wasn't even invented for Wall Street, right? How exactly does a formula built for 1950s telephones apply to my modern brokerage account? That is literally my favorite part of the history. It fundamentally boils down to signal versus noise. Back in 1956, a brilliant researcher named J.L. Kelly Jr. was working alongside Claude Shannon at Bell Labs. They were pioneers of information theory, and they were really just trying to figure out how to push data through long-distance copper telephone lines without random signal noise corrupting the actual message. Wait, so a noisy phone line is essentially the same mathematical problem as a highly volatile stock market? Yes, mathematically they are absolutely identical. The signal is your trading edge, and the noise is the random daily volatility of the market. The gambling community actually recognized this first. In the 1960s, the legendary Ed Thorpe realized Kelly's information theory formula was the perfect way to size his blackjack bets so he could completely conquer the casinos. Once he beat Vegas, he took that exact same math straight to Wall Street. Fast forward to today, and the most successful hedge fund managers on earth, legends like Warren Buffett and Bill Gross, have utilized the core principles of the Kelly Criterion to compound massive generational wealth.
So here is the magic weapon itself, the Kelly formula. K% equals W minus, open parentheses, 1 minus W, close parentheses, divided by R.
Okay, hold on. You're giving me horrible flashbacks to high school algebra right now. Can we get a plain English translation of these variables? What do W and R actually mean for a normal portfolio?
I promise it's so much simpler than it looks. K% is simply the optimal percentage of your total capital you should risk on your very next trade. It outputs as a decimal, so 0.10 just means you risk 10%. W is your win probability, how often your strategy actually makes money, also inputted as a decimal, so a 60% win rate is simply 0.60. And R is your win-to-loss ratio, how big your average winning trades are compared to your average losing trades.
Section 2. Finding your variables.
Okay, that all makes sense conceptually, but proving how a retail trader actually extracts those mathematical inputs from a regular brokerage account is a totally different story. I need to know how to find my actual W and R.
Exactly right. To use the Kelly formula, you need your own historical data. You absolutely cannot guess these inputs. Now, to do this perfectly, you really need to rely on the law of large numbers. Ideally, you want to pull a log of your last 50 to 60 trades from your broker. Anything less, and the data might just be random statistical noise. But just to keep the math super clear for our lab demonstration today, we're going to extract the variables from a simplified log of just 10 simulated trades. All right, so looking at a hypothetical mix of green and red, we've got trades making $500, losing $150, making $200. Out of a 10-trade batch, let's say we have exactly 6 wins and 4 losses. Spot on. That basic counting is the very first step. You just need to know how many times you were right and how much money moved when you were right versus when you were wrong.
Let's break down those two variables formally. First up, W, the win probability. You had 6 wins out of 10 trades, so W is exactly 0.6.
Easy enough. And for R, the win-to-loss ratio, I'm just averaging out the cash values, right? So if I take all those winning dollar amounts and average them out, let's say my average gain is $283, and my average loss across the red trades is $162.
Exactly. And when you divide your average gain of $283 by your average loss of $162, you get 1.74. That is your R. It means you make 1.74 times more when you win than you lose when you're wrong. And just as a quick technical side note here, many retail traders actually have an R lower than 1, meaning their average losers are bigger than their average winners. If your R is below 1, you need a massively high win probability just to survive, let alone grow. But our hypothetical trader right here has a very healthy R of 1.74.
Section 3. Kelly in Excel.
All right, so I have my W at 0.6 and my R at 1.74. But doing this manually every single time I close a trade and update my stats sounds completely exhausting. How do I automate this so the math just does itself?
I am so glad you asked. It is time to fulfill the core promise of this explainer. Let's walk through a live, ground-up Excel build. Open up a completely blank spreadsheet. Step 1. We dedicate a cell for your win probability. Let's use cell B1. You literally just type in 0.60. Step 2. Directly below that, in cell B2, input your win-to-loss ratio. Type in 1.74.
Got it. W is sitting comfortably in B1, R is sitting in B2. What is the exact string I need to type for step 3?
In cell B3, you type this exact formula. Equals B1 minus, open parentheses again, 1 minus B1, close parentheses, divided by B2, close parentheses. Listen, those parentheses are absolutely crucial for the order of operations, so Excel actually calculates the ratio part before the subtraction. Then you just hit Enter and format cell B3 as a percentage. The beauty of this whole setup is that once it's built, you can drag this formula down across hundreds of rows, updating B1 and B2 as your trading stats organically evolve over time. Excel will instantly crunch the optimal Kelly size using your specific living historical edge.
And boom, the result pops right out. The Kelly Criterion is telling you that the mathematically optimal position size for your very next trade is 37% of your total bankroll. Wait, 37%? Are you kidding me? If I have a $100,000 portfolio, you and the math are telling me to put $37,000 into a single trade? That feels completely insane. What if the stock unexpectedly gaps down? Exposing over a third of a portfolio on one single bet does not feel safe at all. You know what? You are having the exact correct rational reaction. As an expert quant, I can tell you that technically, in a sterile vacuum with an infinite bankroll and absolutely no emotional stress, betting exactly 37% here perfectly mathematically maximizes your compound growth over 1,000 trades. But humans don't trade in a sterile vacuum, and that brings us to the most critical pivot in this entire explainer.
Section 4. Full versus fractional Kelly.
The crucial reality is this. Full Kelly is incredibly aggressive. In a rigorous simulation done on the European equity market over a 12-year period using shares of Banca Intesa, betting the exact optimal Full Kelly formula returned the highest compound annual growth rate at 3.27%.
Okay, but taking a half Kelly approach, meaning you take that 37% output from Excel and literally just divide it by 2 to be safe, that still gave a really solid 2.72% return. I've got to say, I will gladly sacrifice 0.5% of growth if it means my portfolio volatility drops and I can actually sleep at night.
And you absolutely should, because betting less than Kelly's severely reduces your volatility while still compounding your money aggressively. But you have to see what happens if you get greedy and bet more than the optimal Kelly amount, say a triple Kelly strategy. Your return drops to negative 0.59%. You actually lose money over a decade, even though the strategy itself has a positive winning edge. And it gets so much worse. If you overbet your edge using that triple Kelly sizing, you don't just slowly bleed cash. You experience the terrifying villain of quantitative finance, a 94.3% maximum drawdown.
Wow. So my $100,000 account would plummet to under $6,000. That's just game over. You're completely wiped out at that point.
Exactly. And let's break down the brutal math of a 94% drawdown for a second. If you lose 94% of your money, you don't need a 94% gain to get back to even. You need a 1,500% gain just to climb back to your starting balance of $100,000. The mathematics absolutely guarantee that if you consistently bet more than the Kelly optimal fraction, you will eventually face total ruin, even if your algorithm is highly profitable. Overbetting is pure poison.
Wow, that really reframes things for me. Having a trading edge means absolutely nothing if your position sizing is wrong. If I have a winning strategy but I size my trades too big, the math actually pulls me into the abyss anyway.
Precisely. Your edge generates the profits, but your position sizing protects the bankroll.
That is exactly why half Kelly or even quarter Kelly is the gold standard for most top-tier hedge funds today. Quarter Kelly still compounds your wealth wonderfully, but it builds a massive structural buffer to absorb unpredictable black swan events.
Section 5. Master the strategy. All right, I'm ready. Give me the golden rules for the modern market so I can actually update my trading plan tonight. Okay, here are your modern trader tips for 2026 algorithmic market conditions. Number 1, always use fractional Kelly. Take your Excel output and just divide it by 2 or 4. Safety first. Number 2, implement a hard cap. The quantitative research strongly suggests never committing more than 20 to 25% of your total capital to a single equity, no matter how high your win probability is. That makes total sense, because Kelly doesn't always account for sudden overnight gap downs, and we all know stop-loss orders won't save you if a stock simply opens 40% lower the next morning. And what about this illusion of control bias? Yeah, that's a really dangerous psychological trap where humans basically overfit data. Traders often think that adding 20 different complex indicators to their chart makes their trades safer. That's the illusion of control. Complexity does not equal safety. True control only comes from rigorous, mathematically sound position sizing based on a brutally honest look at your historical edge.
Well, my Excel lab is officially set up. I've got my automated cells for W and R, and my fractional Kelly formulas are totally ready to go. Thanks so much for walking me through the math. I came into this completely confused about risk, but this totally changes how I view portfolio management. I actually feel empowered to size my trades correctly now.
You are very welcome. We'll leave you, the viewer, with a final provocative thought to heavily consider the next time you open your broker app. Are you actually trading a carefully calculated mathematical edge, or are you just gambling your hard-earned bankroll away with random emotional position sizing? The math does not lie, and it definitely does not forgive. Take the time to calculate your edge, protect your capital with fractional sizing, and let the probabilities work for you. Thanks for joining us for this explainer, and we will catch you next time.